the S&P 500 has moved up or more or less sideways this whole time. And when we have the type of divergence that we have percentage-wise, where utilities dramatically outperform the S&P 500, we usually see a big market correction coming. This happened just before COVID. It happens before a lot of the crashes in the market in general. So that is a warning sign. And of course, gold is on the verge of breaking out. It has been warning us for a long time that the whole economy, the global economy, is starting to struggle, and people are moving away from currencies. They're moving away from a lot of other assets and just going into physical gold. I want to get long gold for a trade. I think there's upside potential to about 4,100, about a 19% rally.
The setup in gold right now reminds Chris Vermeulen of 2007. Back then, stocks reached a slightly higher high, while gold quietly began outperforming. Once equities rolled over, gold took off, blowing past its initial 20% target and ending up with a 37% rally before cooling off. Over the past 20 years, gold has outpaced the U.S. stock market. Gold's return on investment, 616%. The S&P 500, 421%. That's not a small gap. It's a sign something more profound might be shifting. Right now, Vermeulen sees a bull flag pattern forming in gold. His first target is $3,700, followed by $4,100. And unlike the 5-month rally in 2007, this move could happen in just 2 or 3 months. When it breaks, expect a rush, emotional buying, crowded trades, and momentum feeding on itself. In the near term, gold has taken a hit, the most significant drop in 3 months, as traders bet that a U.S. bullion import tariff is less likely, and optimism over a Ukraine-Russia ceasefire has reduced safe haven demand. That's after Friday's rally, which fizzled as the Trump administration left its tariff stance unclear. Vermeulen points out that historically, gold miners led the way in extracting the metal itself. That's where the smart money goes first, because miners are more leveraged. A 1% move in gold can boost miner profits by 5 to 8%, and individual mining stocks can spike 20 to 30% in a single day. Case in point, GDX just had its best quarter ever. Off the back of record gold prices in Q2 2025, gold stocks have been on a tear, up 4.7%, 2.8%, and 1.6% over 3 straight sessions, while gold itself barely moved. That's 33.7x upside leverage. Breakdown. Please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I really like gold. I mean, it has a lot of really strong characteristics. It's had a series of rallies and pauses. As you know, these are known as bull flags, and it's trying to break out right here. I want to get long gold for a trade. I think there's upside potential to about 4,100, about a 19% rally. Back in 2007, when we saw a very similar stock market scenario unfold, I think you and I touched on this our last talk, but the left chart here is the S&P 500 in 2007. The markets made a high, and then it came up and they made a nominal, just a small higher high. And during that time, gold was ripping higher and it was outperforming the stock market. Well, fast forward to today, we had a high in the stock market. Now we've got a nominal new high. Gold is the number one performer yet again. It's been moving higher. And this is a big warning sign. And what happened, if we look at 2007, as I move forward, the stock market started to fall, and watch the yellow line, which is gold. It really starts to break out and take off and extend to the upside. And gold rallied. Back then, the projected target was about 20%, very similar to what we have right now in the gold chart. But gold ended up rallying 37%. It blew right past it. It became the crowded trade, and it just shot past there. So I think we're getting very close to that same scenario. And of course, if that was to play out, if you look at the stock market price, eventually the stock market breaks down and we went into the financial crisis. Stocks fell 55%. Gold pulled back eventually with the bear market. But that's where I think we could be heading with the equities market at some point. But we just need those magnificent 7 to stop getting the money flows into them, which keep dragging these indices higher and higher. But I like the opportunity in gold. As you were saying, it's the charts look really good, and I own a lot of physical gold for long term, and I only buy new physical gold during the start of a new major super cycle. So this trade that I'm looking in gold, it'll probably just be like an ETF, like a GLD or the Sprott Gold ETF, the physical fund. But when you look at the chart of like GLD, for example, Danny, it hasn't broken out yet. If I look at GLD, we're not breaking out based on this bull flag chart pattern. We just take the low. You can use bull flags or Fibonacci, but we take the momentum of this rally up, the height of this rally, and then how deep this three-wave correction was, and we'll just carry that forward. So when we look at price action, we're going, okay, so it had this much power to the upside, it had this much correction power. Where is the upside projected target? And 618, so 61% of this first move is the first target. That's known as the golden ratio. If you ever look into Fibonacci theory, the sequence, it is in everything in the universe, and it's pretty powerful. So these targets that I'm looking for is going to be about 3,700 is the first target. We'll probably see some pause and hiccup there for a few days or potentially a couple of weeks. And then we should have to head up to around 4,100. And just based on kind of this chart pattern, I think the move we're in now is actually going to be quicker and more explosive than this last one. This last one took more or less 1, 2, 3, 4, 5 months. I think this one could happen in like 2 or 3 months, maybe even less. It really depends. We're in this like explosive phase where it should happen very quickly. It'll be a crowded play. I think there's going to be a lot of emotions, a lot of money pushing around, which will create I think a very quick move. So it's a short-term trade, a month or two, and that's my outlook there. Yeah, so we haven't seen gold break out on GLD, and what I like about GLD, and a lot of my charts actually are usually regular trading hours only. So I only show price action during 9:30 to 4 o'clock. That's when the majority of volume shows up for looking at ETFs. And so when gold like GLD actually closes and breaks to a new high, I'll actually be pretty excited because I feel like the breakout will have started. And it hasn't started there yet. I know people are jumping the gun. And when you look at the futures chart, as you just mentioned, the futures chart has broken to new all-time highs today, but really it hasn't in the grand scheme of things when you look at the ETFs and spot price. And what's interesting here is when we look at the gold miners like GDX, even the silver miners, they have already popped and they've already broken out. And, if we use a Fibonacci target here to get an idea on this high momentum, this high volume rally and this pullback, and we carry that forward, we have seen gold gold miners do what we want. They have come up to the 618 level. They've traded sideways for a very long time. If something trades sideways at the golden ratio of 618, we almost always see it go up and hit the 100% measured move, which GDX has now done. And what I like about gold miners when we're in a favorable precious metals market like we are right now is miners move first in most cases, and then gold pops and breaks out. So miners have just hit their target. I'm expecting there actually could see a bit of a pause or pullback. Gold now, I think, is locked and loaded and ready for its first pause, just like the miners have. So I like gold because it's really ready for this first move. And I think we can get positioned into it any day here once we start to see it actually break out. So that's kind of my short-term take on gold and the long-term, that eventually gold will pull back to some regard if and when we hit a financial reset, a bear market. But that's going to be many, many months down the road still. I think it's also only clocking price action in regular trading hours. So gold spikes up high, like today, it spiked up to a new all-time high and a high price. But by the time the 9:30 a.m. opening bell starts, gold is already sold off. There's always a chart I used to look at on the Kitco. It shows you 3 days of gold overlaid on top of each other. I'm actually going to be doing a video on how to day trade gold with it because it's really powerful. But you can see these huge spikes and sell-offs that happen almost at the same hour, the same time every day. It's when the gold market opening closes in London and different places around the world. And GLD just captures a snapshot of what gold has done during the regular trading hours. It's only about a third of the day's trading hours. Gold's 24 hours a day. The stock market, the ETF is only about 8 hours. So that's why we're not seeing these spike highs and lows in GLD, is simply because it's just capturing the snapshot kind of a third of the day. But that's where most of the volume is traded. That's why I like following regular trading hours. Manipulation happens outside of regular trading hours a lot more. Once the market opens, it's a lot harder to manipulate things because there's just a ton more volume you have to try to fake out and shake out. So focusing on regular trading hours for a breakout is, I think it's pretty important. Mining stocks, they've already broken out. They've had that pop in the breakout. That's a good thing. That's a leading indicator. Now we can focus on gold and be with our finger on the trigger. I find gold miners are in this type of scenario, which, we saw like in late 2008 or early 2009, gold miners are the leading move. They'll run and take off, and then physical gold will move next. So I look at gold miners a lot of times as like more or less the kind of shot across the bow, like kind of the get ready. Miners are already moving. I think the reason miners move is because smart money understands that we're in a sweet spot for gold to move higher. They realize there's global chaos, and so they move into the leverage play. If gold is slow, right? A big day in gold is usually like 1%. Miners can move 5 to 8%. The ETFs and individual stocks can move like 20, 30%. So savvy money who's very aggressive, they're going to go into the miners before gold moves because they want to be in position. And so just a bunch of people do that, and it causes the miners to move first for their first leg. And then we'll probably see gold break out, and then miners will take off probably with another leg higher. It's just smart money or aggressive money moving in, front running what they think is going to happen with the price of gold.
Silver's rally just hit a speed bump, but that doesn't mean the move is over. If anything, the chart still suggests a bullish outlook. Chris Vermeulen says silver's price action is choppier and harder to trade than gold's. Big swings, 10%, even 20% corrections, are standard. To catch the real trend, you must take a position and sit through the noise. This week, silver faced selling pressure near $38.10, ending its 6-day winning streak during Asian trading hours on Monday. Globally, it opened last week at $36.96 per ounce and closed at $38.26, a weekly gain of nearly 3% and holding near its highest levels in 13 years. Vermeulen says the bigger picture remains bullish, with higher highs and higher lows. If gold breaks out, silver is likely to follow. The next technical target for silver is about $40.80. However, gold's chart is cleaner and offers more upside, approximately 18% potential compared to silver's 6%, unless silver overshoots its current price. That makes gold the higher probability play. Silver's performance last week slightly outpaced gold, which rose by about 1%. But gold made headlines with a historic jump to $3,534 per ounce after reports that the United States intended to impose tariffs on imported gold bars, a move that rattled the market. Let's get back to the interview.
Silver has a much more noisy chart. I've never been a huge fan of silver until we're in like a different type of market correction. We won't go there, but long story short, silver is still pointing to higher pricing. It's just always really noisy. It is easy to get shaken out of a silver trade. You really have to like take a position and kind of sit back and play the overall longer trend, which when you look at this chart, obviously we have a series of higher lows, a series of higher highs. It's working its way upwards. But you got to go through a lot of 20+% corrections, 10, 15, 20, to stomach it. But if gold breaks out, we're probably going to see silver shoot up. I think the next target for us for silver is about $40.80. It's a pretty ugly chart, hard to gauge based on this sell-off of where it wants to go, but about 40.80. I think there's actually more potential at this point in physical gold itself, just based off what the chart patterns are giving us for targets. Gold is about 18%. Silver is, based on where it is right now today, it's really only looking at 5-6% potential to the upside. Now it could blow past that, but the chart is only saying 6% and gold's showing 18, and gold has a much higher probability of actually working out. The patterns in gold play out way more often than in silver, meaning it's more accurate. You've got less risk, a higher probability. So likely for gold to trade will work out, and you make 3 times as much money as silver. So that's why I'm like kind of steering clear of silver, and the miners also. I like the more consistent play, the one that's likely to work. I like to win versus swinging for the fences and striking out, or just going through that roller coaster ride if you don't have to. The money's moving into the miners. They want to catch a big move, right? So silver and gold miners are moving up. I'm not saying silver is not going to move up. I'm just saying the charts are saying gold is going to move up more. It's more of a global play, where silver to me is more of a speculative play. It's shorter term. It moves very quickly. There's nothing wrong with silver. I just think gold has the highest probability of playing out and can make more. But we should see miners and gold and silver move up together. to some regard. If we zoom way back in time, so many investors are used to falling interest rates and bonds. As rates go down, yields go down, bonds go up. A really good example, of kind of what's unfolding is if we take a look at this. Let's see if I can just zoom out a bit. There's obviously 4 stages to the market, which you and I have talked about a few times, Danny. And these 4 stages, yields eventually put in a massive top, a stage 3 top, just like over here. Then they've gone through a huge bear market. Now rates have gone through a bottom, which is a stage 1 basing formation. And now they're building a launch pad and they're starting a stage 2, pointing to higher pricing. This chart pattern is actually, it's pointing to a really high yield. It's pointing to like 8% if you were to use technical analysis based on this chart. Obviously, that'll wreak havoc. It means there's going to be a financial crisis for sure if that happens on all kinds of levels. But that's what it's saying. And so it's pretty scary of what, the debt market is saying about this. I don't know. I would think mortgage rates will be through the roof. Home prices will crash, which is what I'm expecting anyway. It's gonna wreak havoc on the stock market. It means things are falling apart. If you can collect 8% return with really no risk, people are going to move out of the stock market because a lot of people are worried the market's overvalued. They think it's going to fall. Valuations are out of whack. So it's naturally going to be like, hey, I'll take 8% every day here with no downside risk. So the stock market will be crashing and crash. It'll be terrible. It'll be a financial reset. And that's probably why gold has been doing so well. It's why gold is primed and ready. Just like this chart here, it's a giant bull flag. They're both ready to move higher. And so, yeah, I think it'll be very difficult for everyday people. The stock market will probably become very weak. And the big problem is a lot of people with homes, their home prices are going to drop dramatically. I see like another 15 to potentially 30% drop in the housing pricing if these bubbles and this type of stuff unwinds. And that's a conservative outlook. I remember in 2008, we were looking at homes in Florida. And the house that we were looking at was 550 grand. And my parents ended up buying one there, the same one for 175 grand. We're talking like potentially big resets, and every state and city will have different levels, but volatility. But yeah, this will be very difficult for people and businesses and all of that if it happens. Yeah, we're at a really difficult time to kind of put your finger on which way you should go. So, for example, we have a trend change in the stock market that just happened this week. It is on the verge of it's flipping and flopping. The markets don't know whether they want to go higher or lower. They have run out of steam. But we've got the Magnificent Seven just muscling things higher the last couple of trading sessions. We're seeing 4 or 5 of those Magnificent Seven stocks really push up. And so they're kind of saving the market. But underneath the hood of the markets are pretty weak. So right now we're at this turning point. It's like, do you want to be long? Do you want to be out of the market? And we recently just moved out of the market. And I'll show you some charts here. But overall, from a high level, we're at a turning point, and you got to have a game plan ready. You either need to be ready to be long or get long if you're not, because we could have another leg to the upside, or we could see a big reversal in sell-off. And the charts are pretty interesting. If I pull up the charts, we've got some interesting scenarios here that are kind of unfolding. So let me just show you kind of our trend reversal on the S&P 500. If we look at our trading strategy, which is this color-coded daily chart of SPY, we had a trend reversal early this year, and we went into the tariff crash, and then the market bounced and we kicked back into a high momentum rally. And the markets right now have turned negative from a technical standpoint. Even though the markets are trading near all-time highs, there's not a lot of strength underneath this market. It's really the Magnificent Seven dragging things up, and things are starting to break down. So right now, sometimes we can get these red bars and it could kick back into a green trend and we have another huge leg to the upside, or it could roll over just like it did in earlier this year and sell off quite dramatically. And so that is where, being an active trader or investor comes into play. Right now is the time to stand on the sidelines. We've locked in profits. And if you take a look at what happened last year, so the top chart is the daily chart of QQQ, the NASDAQ 100. The bottom is of the same chart, but last year, it's 2024. And if you look at this year, the top chart and the bottom chart from last year, we are like right on the same kind of chart pattern, the technicals, the sentiment, everything is actually very similar to Last year, we saw a 15% correction. It came back down to near the April lows. The market's a lot higher from the April lows. We'd be more like a 20-25% correction if this was to kick in and repeat. Not saying it's going to happen, but this is something people need to be aware of. And this scenario, this trend change is exactly what took place last year. So that's kind of where we are in a nutshell. Is like, which way are we going to go? We just stepped out of the markets, and the markets are trying to figure out, are they going to continue to go higher and give us confirmation, or are they going to, is this just a little bounce, a little kind of dead cat, or more or less a sucker's rally, gets people in just before it breaks down and really goes precipitous off a cliff. So that's what I see in the markets there, Danny.
When jobless claims hit their highest level since 2021, Wall Street took notice, and so did gold and silver. The odds of a Fed rate cut in September jumped above 80%, making non-yielding bullion look increasingly attractive. Support for precious metals came from more than just weak U.S. labor data. Lower yields on alternative assets added to gold's appeal, while trade tensions between Washington and Beijing, along with possible signs of de-escalation in the Ukraine conflict, kept uncertainty high and demand for safe havens strong. Year to date, the rally has been remarkable. Silver broke above $35 in June and pushed toward $40 in July, its highest level since 2012. Gold has surged roughly 30% since January, driven by record central bank buying and persistent concerns about inflation. Silver began catching up in the second quarter, driven by strong industrial demand and a surge in inflows into silver-backed ETFs. Momentum in both gold and silver is being shaped by a rare mix of technical setups, macro pressures, and shifting capital flows. Miners are signaling ahead of the metal, industrial demand is adding depth to silver's rally, and changing interest rate expectations are stacking the deck in favor of further gains. With volatility returning to the charts and key price levels within striking distance, the stage is set for a potentially rapid move that could redraw the near-term landscape for precious metals. If the next breakout comes, will it be the miners, the metal, or the macro backdrop that delivers the first clear signal? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.